Right, good morning everyone. Welcome to this morning's webinar. My name is Hale and I'm CEO of Air Group. Before we get into the meat of this morning's session, just a couple of admin housekeeping pieces. So just to let everyone know that we will be recording this morning's webinar. So hopefully that's okay with everyone. Also, we've only invited a fairly sort of small group. We're expecting not more than about 20 attendees. We'd like to keep the session, therefore, as interactive as possible. So if you feel comfortable, please do put on your camera and feel free to come off mute at any point where you would like to speak or raise a question. And just in terms of questions, we do have the Q&A functionality enabled, so do please sort of place questions there, or use the chat on the Teams function, or indeed otherwise do use the raise a hand function, or go old school and wave your hands at us and let us know that you'd like to speak. But hopefully many of you will have been on these webinars before, so it should all work fairly smoothly. So we're going to run for about 30 minutes. So the idea will be to close at 10 o'clock promptly. I'm sure everyone's got busy days ahead, so we'll try and keep to time. In that vein, I will kick off with a few introductory remarks and a little bit of context before handing over to Fran for the main body of the webinar. So Fran, if we could skip on to the next slide, thank you. So just by way of introduction, I think most people on this webinar certainly sort of don't need telling that it's been a tough couple of years for the later life lending market. But I think really encouragingly, what we've seen in Air is a very strong start to 2025. If we just look at some of the key metrics that we look at within Air, we can see that our KFI value has gone up 45% year on year, if you look at to the end of Q1. And similarly on completions through Air Club, those are also up 45% in value terms. So quite impressive growth, and I think that's, given Air's share of the market, I think that can be read across as indicative of where the market is as a whole. I think probably notably, if you look at units on both of those metrics, they're slightly lower, so it does point to also some of the higher value cases coming back into the market that we perhaps haven't seen over the last couple of years. So all in all, I think quite a positive environment for all of us operating in this sector. However, and there's always a but, isn't there? But I think, again, most people won't need telling, but we are going through a period of fairly intense volatility at the moment, driven by some of the macroeconomic and geopolitical pressures that we're seeing across the world, but most notably probably by Mr. Trump in the US. And what does that mean for our market? Well, again, as is sort of fairly regularly trailed, our lenders in this market pay particular attention to 15-year gilt rates. And if you have a look at that graph on the right-hand side, which shows the trends in gilt rates since the start of the year, you can see quite a volatile picture. So I think what that does, going on to the sort of final point in this slide, is it highlights that we're in quite a challenging time period for advisors and indeed customers. Rates are bouncing around quite a lot, and given some of the sort of pressures on rates, again, there may well be pressures around product availability going forward. So as an advisor, I think it's really important that you're using the resources available to keep abreast of everything going on in the market, making sure you're kept informed and you have all the information at your fingertips in order to be able to advise customers in the best way possible. And as Air, that's where we see us playing a key role. We want to make sure that we're providing you with all the insights and tools to make sure that you're informed and, as I say, can support your customers in the best possible way. So on to the next slide. In that vein, we wanted this morning to provide you with an exclusive update from one of our ambassador partners. So delighted to welcome Fran from More2life to the webinar this morning. And Fran's going to give us a bit of an insight from a more2life perspective around what advisors can expect in the coming weeks around sort of pricing of products and availability of products in the lifetime mortgage space. So Fran, I'll pause there and hand over to you.
Oh, thank you very much, Will, and thank you for the invitation. Yes, I mean, it is, interesting times for us in the lifetime mortgage space. And those of you who are on call that know me already will hopefully know the mortgage proposition. But for those of you that may not know us that well, More2life are a multi-funded proposition that have, funding options and product options for customers in every sector of the market. And what we're hoping to do today is just to give you an insight into, what that might do, the current economic climate and everything Will's talked about there in terms of what we will deliver and what advisors will have access to for their customers. So, the market uncertainty and that volatility is going to bring change, whether we like it or not, and we will do our best to remain in all of those kind of areas. And we know that we've seen an amount of short-term gilt volatility. Now, gilts are very important to the lifetime mortgage market and the rates that we charge. And I think it's worth just briefly pausing there to explain that why that is for anybody who may not know or might just, value a recap on what that is. So in terms of the gilt markets, you have a lot of our funders are insurance-based kind of organizations. So when they look to invest to get a return on their investment, they can look to either the gilt markets, which gives a guaranteed return, or they can look to invest into property. Now, if they're going to invest into property, they obviously need the property to perform better than the gilt markets would because it doesn't travel with any of those like guarantees. Now, something which, as I say, we do watch very closely is that movement of that long dated gilts, and particularly the 15-year gilt market is where we look. Now, lifetime mortgages are long-term products, and us as lenders rely on those gilts as a benchmark for what it's going to cost us to lend money over those potential decades. So when gilt yields rise, which they have done in this current environment of inflation and bank tightening through the likes of Solvency II, which I might touch upon quite briefly, lenders' own funding costs increase, and that therefore puts upward pressure on customer rates. Now, that's in turn going to cause, as we see, the expected volatility, meaning it grows uncertainty for us, for our funders. Now, in addition to that, you've seen the interest rates on gilts really jump up and down. And you can see there where I've put that on that graph, thanks to our lovely marketing team to provide it. We had, in the space of 4 days, the lowest gilt rate in 2025, and 4 days later, the highest gilt rate in 2025. And I've been looking at the gilt rates again over yesterday and tomorrow, and they're just bouncing around like ping pong balls. So we have seen that before, and we did see it in 2022. And although the impact isn't expected to be quite as widespread, we do know that this is going to travel with an upward rate pressure. So in the short term, that is, or at least the short, potentially to the medium thing, that is where we are going to potentially see some of that change. Now, what we've got in front of you here is the current lending position of our four well, actually four funders, but 5 different product areas. So as I say, we're a multi-funded proposition that's there to capture the needs of customers with every kind of need, from our capital and flexi products, which tend to offer the best terms in the market, right the way through up to our maxi and tailored ranges, which then sort of hit more towards the higher end of the loan to value release. Now, again, it's not too dire. Nobody needs to overly panic that the market's going to disappear, because actually the average loan to value for a 7-year-old, which is still roughly the average age of the lifetime mortgage borrower, is actually 27.3% there. So we still sit as a provider highly above that space to be able to deliver good outcomes for customers. But it is going to challenge, and it has been a challenge in that high loan to value space since the mini budget of 2022. So we are expecting challenges to grow that in the short term. Now, more2life are known for their ability to innovate and be able to bring, solutions to the market outside of anybody else. But we are concerned about what you can see we've highlighted there on screen, these very high loan to value areas, because actually specifically around our tailored enhanced ranges, you see they're outliers in that high loan to value space. So we are anticipating that funder is and are known to be reducing their risk appetite to come down to something that's more aligned to the current market opportunity with risks taken into account. Now, again, when we talk about why is it important that when funders see rates go up as they are at the moment, why does that impact that loan to value? And it's sort of multifolded why that would be, because as we do know that these funders need to offset their long-term risk, as I say, funding them over decades. As rates increase, that means that rates are going to, the doubling rate, as we call it, the rate in which debt is going to increase will happen quicker. And that also means through those things where they've got that cost of the no negative equity guarantee, which we enjoy in this market, as those rates increase and that doubling increases as well, that means that's more likely to be hit as a ceiling. And it also means through Solvency II, which a very brief explanation is, well, it's a European directive that was sort of slackened a little bit in the UK post-Brexit, but it does require funders and lenders to actually look at their capital adequacy and increase it to offset things like if they are going to have to fund a no negative equity guarantee, or if customers actually just live longer as well, and the impact that can have them on getting their return on their investment. So there's lots of different things playing into the fact that these funders then, when they see that, to protect themselves from that risk and also control how much capital that they have to put away, which ultimately also impacts how much they can borrow and therefore how much investment they can get back in, they look to reduce their loan to values. And that is where we do know imminently tailored, which as you can see on that graph has been holding itself out to be the lender for those customers who want those higher releases, are going to reduce that. So the big message is guys, we're probably looking at Tuesday. We're expecting the shoe to drop on this. So right now, you have got definitely in the single life space tailored that are going to be able to supply customers in that high loan to value. Maxi, if it's a joint life, or if they have got an impaired life, please do remember to complete those health questions to be able to see what those customers can achieve in either a lower rate or a higher release. And again, just to remind you, even somebody being overweight will be enough to qualify for enhancements. 63.8% of adults in the UK are actually travelling with either being overweight or indeed dealing with obesity. So even just somebody's height and weight is a valuable indicator of whether or not they'd be able to get enhanced terms. But there are still several ways in which you can serve your clients. more2life, again, as I said, we are being known to be the innovator. We talk about here of the innovation with Flexi PTLM, but I want to remind everybody, going back to when I joined this company and we went into lockdown 3 weeks later, we were the first lender to create, desktop-based valuations to keep this market trading through very difficult times. And we have brought multiple funders back to market when they did withdraw from the market, and then brought some of them back again, offering great facilities. But we have very much looked to support a new and emerging customer through the likes of our flexi payment term lifetime mortgage, that hybrid mortgage that's available for customers to release higher amounts at much lower ages should they have an ability and a willingness to make a legally bind payment for a period of time. Now, we did, as I say, reintroduce tailored enhanced to the market, which has drove the return of medical enhancements. And again, the benefits that we have in the market of talking about those different conditions that actually can get a great customer outcome. We did launch last year a very, very, very popular Maxi Zero product, that product that is unique in the market, the only one that has no ERCs if you look to redeem. That product is for people that do have a lifetime mortgage borrowing need, but foresee that they could have a reason to redeem it in the formative years of that plan, and therefore want to do so without having to worry about incurring that early repayment charge. Then we have looked to more recently bring to market our Flexi Interest Rewards, which is an interest reward type product, doesn't travel with a threat of repossession as a product such as the hybrid mortgages do that are governed by MCOB, but is one that with somebody with an ability and a willingness to make a payment can do so on this product and reduce the burden of their debt twofold, once by making the payments in their own right, but also because they're making those payments, they're getting a lower rate of interest. And please, if you're interested in exploring that product more and our next product, which was our tailored interest reward, please look out for some upcoming webinars, because those two products have some fantastic features and superpowers, including on flexi interest reward, the ability to overpay and shorten your contractual payment. And also, if your world does blow up and you do have to stop making payments, it is the only plan that gives you an opportunity to retain that lifelong discount, or a part of it at least. So please do look out for that. And our tailored interest rewards are for people who probably in the higher release space also value being able to make a decision on whether they need to or can make a payment on a month-by-month basis, but also enjoy the flexibility of things like payment holidays on an annual basis. So again, please watch out for further details of them to come. Now, we also have towards the end of May going to do some specific promotions around our criteria updates. I have lost count of the number of improvements we've made across specifically 3 of our plans, our flexi, our capital, and a lot of improvements on our tailored interest reward in terms of expanding our customer footprint. So at more2life, we can find a path to yes for more people. And in terms of our other improvements, we have also got a new facility with drawdown. So at more2life, we offer you 2 ways of dealing with some drawdown. Customers can call up and speak to our operatives, but actually, if they want a quicker and more efficient journey, we do have a form they can fill in online, which will deliver them much faster outcomes for their drawdown needs. And we are working hard to bring you even more, as we always are. Our management never let us good people rest for a second. We are looking to hopefully have a return to that higher loan to value space, and we're working to launch that this half of the year, this side of summer, hopefully. So watch this space again for promotions on what we look to do there. And we are also looking at streamlining the advice journey. So I talk about within more2life of us having a path to yes, but it's really important that we get a path to yes that's efficient and, effective for advisors. And there's 3 reasons why that would be. Selfishly, from a lender point of view, if a case, cannot be lent on because there's something fundamental about the security that isn't going to work for our funders, then we don't want to obviously spend that resource on that case. And you guys also don't want to spend the resource on making those recommendations for something that's not going to go ahead. But most importantly, at the centre of everything we do at more2life is the customer outcome. And in this very uncertain and rate up environment, if you've got a period where you put in an application in all good faith and it takes a week to 10 days, for us to be able to make that decision, and it usually doesn't take that long, but we do still have the fast path promise that will, pay a compensation to the customer should we not make that decision within that time. T's and C's apply, people, so please do refer to them for more on that. We are actually building something fantastic at the front end that you'll be able to use pre-application, even when you've got that lead brand new on your desk, if you wish to, where we can check out multiple risk factors of the property and the individual and let you know what our plan A is for that customer. But don't forget, though, if plan A doesn't work out, more2life still does have the broadest range of plan Bs, and we can get your customer, if it does go wrong post valuation or even post offer at the legal stage, have more opportunity for you to find another path to yes via one of our alternative funders. So we can get your customer up and running and back towards achieving their financial objectives within 48 hours. So that's probably it. That Whittle's top tour from more2life. That warning, please get your KFAs in now if you've got any inquiries or customers in the high loan to value space looking to use a tailored enhanced or tailored choice or a maxi choice product, because that is my other concern. Once tailored take themselves out of the running, I always liken it to like the scene in Dad's Army, Will, where everybody, they ask for a volunteer but nobody steps forward, but everybody pours out sex back. And that sometimes then can ricochet like a house of cards on other funders if they find them then in the top seat and needing to adjust their risk appetite. And on that note, then handing back to Will, I guess, to then us look at any questions from the audience or from Will, either on anything I've just said?
Fran, thank you very much for the update. That was very helpful. No questions sort of coming in at the moment, although just as I say that, Tom has raised his hand. So Tom, do come off mute and ask your question.
Trying to see if I can help Tom. I'm not sure if I can. Let's see.
Hiya, can you hear me?
We can now, Tom. There you go.
Perfect, thank you. So obviously I saw on the meeting invite, it was looking like a potential new product launch. I assume that's been rolled back, and that was the product that's H1, and that's market volatility, I assume.
So not roll back, but just baking to perfection, Tom, is what I would call it. So definitely watch this space where we know there's going to be a need. Right now, our call to action is you've got products and services in the market that can actually deliver outcomes for those customers. So that's the call to action: tailored, enhanced, tailored choice, maxi choice. If you've got customers in that space right now, let's get that KFI locked in so you can lock in the best terms. And as and when more2life innovate next, which it's never usually long, we will definitely be updating Air more likely as an exclusive in that space on those developments.
Okay, you know, don't worry. I've already spent most of yesterday going through my tailored enhanced, getting new quotes.
Fabulous. And that is the best thing to do. And you know what, as I say, I've got one particular broker, and if she watches this back, she'll know, I won't need to mention her name, who it is, that does dozens and dozens of quotes with every customer to lock in all of those plan A's, but all of those plan B's as well. I mean, one of the things that we are also looking at is also being able to provide customers or advisors a heads up on what we think the likely valuation is going to be once the physical valuation takes place. So again, you'll be able to lock in different KFIs with different scenarios on up vals and down vals as well. So it's a time for us all to get it right first time, to protect that customer and deliver them those best outcomes we can, with almost a little bit of hindsight in our review mirror.
But Tom, I think the premise of your question is right, and certainly as Air, as we talk to all of the lenders and third-party funders around the market, you know, we will endeavour to make sure we keep members up to date with everything going on. But certainly, as you rightly point out, with the amount of volatility in the market at the moment, sort of plans are sort of fluid across the market. So I think it's that is an important point to note. And as I say, you know, Fran's call to action is absolutely the right one, which it sounds that you and others are embracing, which is, you know, take advantage of what's available here and now. And I say, hopefully we can help as many customers as possible with what's here. And then hopefully looking forward, there'll be more product availability and sharper rates in the market as we move forward.
Yeah, I think there's an actual live example I had post Trustonomics. Actually, I was in Mauritius when all of that happened and watched it with interest, and landed back in the UK to the challenges that we faced then. And there was a broker phoned me and said, Fran, I'm thinking I'm doing something wrong on sourcing. I quoted this customer a couple of months ago and I could get X. I'm now quoting them and they can only get Y, and that's massively off their need. Based on them needing to repay that interest-only mortgage. And there was a good while after that where there was a cohort of customers that could simply no longer be helped. So yeah, if you can get as much of that locked in as possible, then, because we don't know what the immediate impact is going to be. As I said, the deck of cards piece concerns me. Well, I don't know about you, because as again, I don't know the audience. They might be too young to remember Dad's Army, but you know, it will fall. You know, if somebody moves backwards and that leaves somebody else up here, then that then potentially impacts on them, and then you get a general downgrading on the loan to values available in the market. So there is definitely time to take action now, and then watch this space, because more2life, as we always have, will hopefully come back and deliver something. But we even seen post Trustonomics, whilst the loan to values creeped back, it didn't shoot back. So there will be people that, you know, will unfortunately fall between those cracks, and if we can avoid as much of that as possible, that'd be great.
Thanks, Fran. Just looking around the virtual room, whether there's sort of any further questions for Fran. If not, and maybe have a think, guys, but I'll jump in with one of my own, Fran, and sort of going to your point around sort of streamlining the advice journey. One of the sort of constant sort of pushbacks we get from advisors is around lender criteria, and the frustration I think advisors have and customers have around some properties that are not acceptable to lenders. Could you perhaps give us a sort of little bit of sort of insight as to why things such as, you know, proximity to commercial premises are so challenging for lifetime mortgage lenders, particularly for maybe advisors coming out of the mainstream space where those properties sort of would be available to lend on through many lenders? Bit of insight on that might be helpful, and any tips for advisors as they sort of deal with perhaps these more complex or difficult properties as to how they can get to a product outcome.
100%. So it's all about saleability, future saleability, Will, at the end of the day. The thing, especially if you are from general practice, to note, and sort of referenced it earlier before, with the likes of equity release and versus standard mortgages, you know, we don't expect to see a property on our books for a short period of time. We expect it to be on the books for a long period of time. So whereas the average turnaround actually for a standard mortgage in the general practice would be 3.8 years is how long they expect to keep that market. With ourselves, it's, you know, we're, you know, for the youngest borrower, anticipating terms of over 30 years. So in that 30-year period, you know, we have to think about that return on investment, and it is all about then that future saleability. Now, proximity to commercial is all about, I say, just think about the nature of the commercial and the geographic biases. So we do have funders that will take on people that have got commercial to the left, to the right, to the back of it, as long as it's not physically touching a wall, a ceiling, or a floor. However, it does depend on the nature of that commercial and the valuer's comment. So next door to a pub, problem. On policy, no. If that's a Weatherspoon in a I live in Brittle, I was born in Brittle, so I can call it out myself, you know, sort of a lower socioeconomic group, then that's probably going to be a problem. But when you're talking about in a village, having a pub next door to you actually would be a selling point. So again, it's those kind of, think about the environment and the ultimate impact on the saleability. So you called out proximity to commercials, probably one of the most common questions, Will. There's other aspects of that, again, in terms of construction type. Look out for things, hints and tips. We do see a lot of non-standard construction declines. It's not usually the main house. It's usually the extension they've thrown up, or the annex they've built in the garden is usually the bit that's non-standard. So do ask questions around not just the main house, but the construction of any outbuildings or extensions that they may have. Things like flood. Flood is an increasing risk factor in this, especially global warming future that we look at. And again, there's across our panel, we've got 3 different ways in which we can assess a flood risk, and different funders that will look at flood differently. So we can have an out and out decline on 1 or 2 funders, but a complete accept on the other. And you can do that flood check through our broker support team, again, pre-app, to save you and the customer any frustration of, you know, your plan A falling down at that point. Other most common questions is around these days adverse credit. So again, if you're general practice, you're probably used to getting a copy of somebody's credit report up front. But again, if anybody's got any CCJs, adverse defaults, you know, DMPs or IVAs, we do have solutions for people with credit, even those that want to pay off their bad debt, but it does vary by funder. So again, using the pre-app service, and especially as we launch our new souped up pre-app service, you're going to be able to get a much more accurate read on whether or not we're going to have a solution for your customer going forward. Does that answer your question, Will? There's so much I could talk about criteria for hours, because there's so much to it.
No, it does, Fran. Thank you. I mean, it's probably, as you say, probably a subject for a whole new call. But sort of coming from an advisor's perspective, it is clearly an area of concern. I think, you know, not only are you burning the costs on the acquisition side, but then if you're burning costs to serve as well while you're trying to search the market to find a home, it's you know, it can be a fairly sort of challenging sort of process commercially. So the work that more2life and perhaps others are doing in trying to get to a decision more quickly you're certainly going to be welcomed, I think, by Air's members and the advice community more generally. So no, we look forward to hearing more on that, and as I say, maybe a subject for a future webinar. But I'm very conscious of time, so I'm going to sort of move us on to the final slide, and just to sort of maybe make some final observations and conclusions. I think sort of the message sort of from the webinar is loud and clear that, you know, whilst More to Life and other lenders will be looking to bring sort of more product options to the market, here and now the market volatility puts question marks around both rates and LTV availability, and therefore trying to find ways to serve your customers here and now with the products that are available, securing rates through sourcing KFIs, and trying to make sure that you are revisiting your pipeline ASAP has to be sort of the right message for all our members at the moment. And Air's here to help as well. So again, anything we can do to help you sort of place the business more efficiently, please do use our inquiry service, use the tools and other sort of resources available in order to help. And the final message, and it's one I want to stress, is please do place your business through Air Club submission reads. It is the way to make sure that you get best access to preferential rates, but it's really important for us commercially as well to ensure that we get a return on the investment we make to grow the market, and we can continue to put that investment back into supporting our members. So thank you very much for your time today. Really much appreciated. If you've got sort of any questions following the webinar, please do reach out, I'm sure, to Fran directly, or indeed to myself or the Air team, and we'd be delighted to help. But once again, thank you for your time. Have a good weekend. Let's hope the weather holds at least for a few more days, and lots to do in the next few weeks to help our customers. Thank you all.